key to getting a deal in today's real estate market is to eliminate the competition. When you find a property, if there are other people interested in that same home, you have to pay more, or you may have to pay more. You simply lose negotiating power. Like if there's just one other person bidding on the same house, it typically ends up costing you, and sometimes a lot. Right now, the high interest rates have scared away a ton of buyers, and you can use this to your advantage. You can use it to find a listing where there aren't other buyers competing. Remember, the price you may pay for a property is permanent, but your home loan rate is not. Check out this recent article which shows that the average monthly car payment has revved up to $729, and this figure only keeps rising. But let's park that thought for a second and consider this. In today's home buying world, $100,000 on your mortgage is roughly the same. Every $100,000 works out to be just under $700 a month. So which would you rather have? A $729 car payment or additional $100,000 towards your next home? To this day, this is still one of the biggest mistakes young home buyers make. Thinking you need to save up big 20% down payment to buy your first home, just to avoid PMI. Now let's look at the numbers on this. If you bought a home for $450,000 and you put 5% down, you would pay approximately $170 a month in PMI. Over 3 years, that's a total of $6,120 just in PMI. Now, if you decide to wait 3 years to buy that same home and save up 20% down, that $450,000 home is now worth approximately $506,000. Now, you just spent $56,000 in order to save $6,120. You know, as a landlord myself, I get tons of stories. Don't buy a rental property because the tenants will call you at 2 a.m. to fix the toilet or to change a light bulb. You know, this idea has kept so many people from renting out their current home and becoming a landlord. But if you ask many of my clients who own a lot of rentals, they will tell you that this fear is way overblown. You see, the truth is handling tenants, property maintenance, and curveballs can be a hassle at times, but the simple solution is just to get a property manager. It's actually super affordable and will save you a ton of time. The manager will take anywhere from 5 to 10 to 15% of the rent, and they'll take the wheel on everything. For many of my clients who utilize these services, they just get the monthly rent directly deposited into their bank and never hear about many of the issues. You know, there are 3 things I would definitely not do before starting the mortgage process or home buying process. Number 1, do not co-sign for anyone else's debt. If a friend or family member asks you to co-sign for anything, 99% of the time the answer should be no. This can reduce the amount of home you can qualify for, or in the worst case, kill your approval altogether. Number 2, switching from a regular W-2 job to an independent contractor or starting a new business. This will cause you to have to wait up to 2 years before being able to buy. Number 3, relying on internet tools and calculators for all your info. Don't get me wrong, I love do-it-yourself online too, but most online real estate and mortgage tools have just general or incorrect information. I know it seems backwards, but there is a lot of information that is wrong out there. And again, this sounds backwards, but you will save yourself so much time by just asking an expert for guidance. Give me 39 seconds and I'll show you how to buy a home without selling your current home in 2024. Most people who own a home and have a great rate don't want to give up that rate, and that's normal, especially when rates were in the 2% range. But here's where the home equity line of credit can come in. Home equity line of credit, or HELOC for short, you can tap into the value of your home's existing equity and use it for the down payment on your next property. Your first mortgage with the crazy low rate remains untouched, so you can have your cake and technically you can eat it too. You can then turn your first home into a money-making rental property. Currently, there are a ton of people looking to rent because they can't afford to buy a home in this market. So this in itself is keeping rents pretty strong. The monthly rent you bring in will cover your original mortgage, and might cover some of the HELOC payment as well. If you have a total household income of $100,000 a year, can you afford to buy a home in today's market? Let me show you an example on how to calculate this. If you make $100,000 a year, this works out to $8,333 a month gross or before taxes. The total of your house payment and all other monthly debts cannot be higher than 50% of your total monthly income amount, and that's gross. This means your total debts can't be higher than $4,166 a month. Now let's say your car payment and other debts total up to $800 in monthly payment. Well, this means you have $3,366 a month left for your maximum total house payment. You might ask, what does that get us in today's housing market? Assuming a 10% down payment, you could be looking at a house priced around the $450,000 mark. Of course, that depends on our area. I've got a quick home upgrade that will seriously crank up your home's value. Hit the front door with a fresh coat of paint. Go bold, sleek jet black or vibrant red. Why? Well, your front door is the gateway to everything. And we all know that a solid first impression counts. You only have one chance to make a first impression. A splash of color not only boosts curb appeal, but can also make your place the standout star in a sea of sameness. So for less than $100 in paint, you could add a cool $5,000 to your property value. You know, Americans are now sitting on a new record amount of home equity. Here are 3 ways to cash in on this surge of money and how you can access it. Number 1, you use the funds as a down payment for your new home without worrying about selling your current home. Number 2, you can pay off other high interest debts to free up monthly cash flow. Number 3, you can make amazing renovations to your current home. You could also do a combination of any of these 3 options. Now, how do you access the funds without selling your home? Well, there are a couple of ways. You can either do a cash out refinance, which is refinancing the mortgage and taking cash out of the property, or you can do a home equity line of credit, also known as a HELOC.